Your 7% mortgage isn't stuck because of the Federal Reserve. It's stuck because of Japan on a $400,000 loan. That's $500, $700 extra every month. And the real decision maker might be 6,000 miles away in Tokyo. Daniel in Ohio refreshes his rate, quote, 7%. The Fed signaled cuts, nothing changed. Mortgage rates don't answer only to the Fed. Most people blame the Fed, but Daniel's 7% mortgage isn't just a Fed story. It starts in Tokyo. In 2024, the Bank of Japan ended yield curve control after decades of keeping long-term rates near zero. It also raised rates for the first time in 17 years, and then again, on the surface, those moves looked small. In global bond markets, they were not. To understand why, consider two people, Daniel in Ohio and Kenji in Tokyo. Daniel sees 7%. Kenji sees a shrinking spread. Same number. Different consequences. In the 1990s, Japan cut interest rates to zero and kept them there for decades. That pushed trillions of dollars to seek yield overseas, especially in US bonds. If your domestic 10-year bond yields 0%, and you're a life insurer promising 2% returns to policyholders, you have a problem. Japanese insurers, pension funds, and banks looked abroad. They found the United States for decades. Japan became one of the largest foreign holders of US Treasuries. This was steady allocation by institutions. That demand mattered. US mortgage rates are based on long-term Treasury yields and mortgage-backed securities pricing. When large buyers show up at Treasury auctions, demand is stronger. Strong demand generally supports lower yields. Lower yields can mean lower borrowing costs for households like Daniel. Here's the shift. For 30 years, low Japanese yields pushed capital into US bonds. In 2024, that pressure began to ease. Same mortgage market, different global backdrop. Now look at Kenji. Kenji manages a large portfolio in Tokyo. For years, he could borrow in yen near 0% and invest in US Treasuries yielding around 4%. If Japan can borrow at 0% and earn 4% in the US, that 4% gap is profit. If that gap shrinks, the trade loses appeal. If the spread drops from 3 to 1%, a $50 billion portfolio doesn't earn $1.5 billion anymore. It earns $500 million. That's a $1 billion shift in incentive. No headlines, just math. Multiply that across insurers, pension funds, banks, and hedge funds, and trillions of dollars follow the same logic. The chain is simple. When Japanese yields rise, the spread shrinks. When the spread shrinks, money stays home. When money stays home, US yields rise. For decades, the assumption was that Japanese rates would stay near zero. That made funding predictable and cheap in 2024. That changed. The Bank of Japan ended formal yield curve control. Long-term yields could move higher. Short-term rates moved above zero. Small moves matter. If Japanese 10-year yields move from near 0% toward 1% or higher, the gap versus a 4.5% US Treasury narrows after hedging costs, the cushion can shrink quickly. When the gap narrows, incentives change. Now, back to Daniel. Daniel hears about Fed cuts and expects mortgage rates to fall. But mortgage rates track long-term Treasury yields more closely than short-term Fed policy. The Fed controls short-term rates. The market sets long-term rates. That market is global. If Japanese institutions buy fewer US Treasuries or let holdings roll off without reinvesting, another buyer must replace them. To attract that buyer, yields may need to rise. Bond markets move on marginal buyers. Japan has long been one of the world's largest net creditor nations. Its institutions hold trillions in foreign assets, including over $1 trillion in US Treasuries. If just 5% of a $1 trillion Treasury allocation is reduced or not rolled over, that's $50 billion in demand that disappears. That doesn't guarantee a spike, but it means the next inflation scare or deficit headline hits a market with less demand. That's where pressure builds. If even 10% of a multi-trillion-dollar carry trade unwinds in a single quarter, the 10-year Treasury can jump. Mortgages reprice in weeks, not years. A move in the 10-year Treasury from 4% to 4.5% feeds into mortgage-backed securities. A 6.5% mortgage can become 7% quickly. Daniel doesn't see Tokyo on his loan estimate, but Tokyo is in the math. Earlier, we mapped the chain. That same chain can run in reverse. Higher Japanese yields, narrower carry Sunday, weaker Treasury demand, fire US long-term yields. Bond demand isn't the only channel. There's also currency. If Japanese investors repatriate capital, they sell dollars and buy yen. A stronger yen can tighten financial conditions globally. Multinationals feel it. Exporters feel it. Earnings expectations adjust. Capital flows affect yields. Currency flows affect risk appetite. Markets don't need a crisis to reprice. They need a broken assumption. For 30 years, the assumption was near zero Japanese yields. That anchor is gone. There are three paths from here, and one matters most for your mortgage. Path 1, slow normalization. Path 2, fast repricing. Path 3, stabilization. Base case, Japanese rates rise gradually. Capital flows adjust slowly. The US still offers higher yields, but the gap is smaller. Japanese insurers don't rush home, but they also don't reach as aggressively abroad. That means less marginal demand for US treasuries. For Daniel, 7% mortgages may reflect tighter global liquidity than the ultra-low era. Downside case, Japanese yields rise faster than expected. Funding costs in yen climb toward 2%. US yields sit at 4.5%. That 4-point carry becomes 2.5 before hedging. After hedging, it may be much less. Behavior changes quickly. Positions get trimmed, US bonds get sold or not rolled. Yields adjust upward. Upside case, Japanese normalization stays measured and global growth softens. Other buyers step in for treasuries, yields stabilize, mortgage rates ease gradually. All three scenarios revolve around spreads and incentives. If you care about where mortgage rates go next, watch three numbers: Japan's 10-year yield, the US 10-year yield, and the gap between them. That spread influences trillions in capital and your monthly payment. When it widens, the carry strengthens. When it compresses, expect adjustment. Daniel refreshes his mortgage page again. He thought he was waiting on the Fed. He's also waiting on Tokyo. US long-term yields can look like a domestic inflation story. Sometimes they are, but sometimes they reflect global capital flows. If you ignore that, you miss part of the signal. Return to our two people. Daniel is choosing a mortgage term. Kenji's allocating billions. Daniel thinks he's waiting on a 0.25% Fed cut. He may be waiting on a $1 trillion capital shift in Japan. Until that spread widens again, 7% mortgages may remain common. If you're a homeowner, remember this. Mortgage rates are tied to long-term yields shaped by global demand. Watching only Fed press conferences shows only part of the picture. If you're an investor, duration risk matters. When long-term yields rise, long-duration assets, long bonds, and high-growth equities face valuation pressure. When yields stabilize, those assets can recover. Keep this in mind. When the world's largest creditor changes its thermostat, others feel the shift. If you care about your mortgage, check the USC Japan 10-year spread once a month. It may tell you more than the next Fed speech. For decades, it barely moved. In 2024, it moved. Daniel sees 7%. Kenji sees a compressed spread. The bond market sees incentives change. Now I want your position. Comment rising if you think Japan moves toward materially higher long-term yields over time. Comment stable if you think this was a one-off adjustment and yields settle near current levels. I'll track both camps and revisit the data in the next video. The real question isn't just where the Fed goes. It's whether the world's ATM keeps dispensing cheap capital or tightens the flow. That answer may determine whether 7% mortgages are temporary or the new baseline.